Hello and Happy New Year. This is Dave Alison, founder and CEO of Alison Wealth Management, and I want to welcome you to our Q1 2024 Market Intel Report. In this report, we're going to discuss the three key themes that are on the minds of investors today. The first one being the overall resiliency of the U.S. economy. In 2023, I delivered a market intel report to start the year, and I shared a statistic that the number of economists that believed that we were going to enter a recession in 2023 was at an all-time high. We had soaring inflation. The Federal Reserve was about to embark upon a very aggressive interest rate hiking campaign to try to curb inflation. And there was a lot of people that were quite negative on the outlook of the United States economy. Well, here we are in early 2024 looking back, and of course we saw that the Federal Reserve's battle on inflation is working. We ended 2023 at a core inflation of near 3%. And in the face of higher interest rates, we saw that U.S. consumers kept spending, which really drove the overall growth in the U.S. economy. Of course, now our attention turns to, can those trends continue into 2024? And I want to look at a couple data points, of course, of where the state of the U.S. economy is today, and most importantly, what's ahead. As I mentioned earlier, inflation continues to come down, and as long as we stay on that downward trend, that should lead to a healthy U.S. economy. We saw retail spending continue to power the United States economy, producing good growth. But of course, as we all know, typically with the economy, the biggest risks to the economy often are the ones that we don't see coming. So there are some potentials that this picture could change, but as of right now, we see a very strong and healthy labor market. Consumer financial balance sheets seem to be pretty healthy, although we're starting to see a slight rise in credit card delinquencies. Of course, retail spending seems to be quite healthy, which overall tend to lead to economic growth. Now that turns our attention to our second key theme on the minds of investors today. What happens if and when the Federal Reserve starts to cut interest rates? The FOMC is projecting a few interest rate cuts in 2024. You can see based on the data on this chart, they are forecasting a year-end interest rate of about 4.6%. Now, the overall market is actually forecasting and anticipating a little bit more of an accelerated cut to interest rates. They are forecasting that interest rates start to be cut earlier in the year, potentially in the second quarter, and we actually end the year at about 3.6%. So again, a little bit of a variance between what the FOMC is projecting and what the overall markets are anticipating. But what I want to talk about is what we've seen historically from the stock market if and when the Federal Reserve does start to cut interest rates. Now, some people believe that the Federal Reserve will not start to cut interest rates until there's a certain level of pain felt in the economy. In this chart, it shows the average stock market return over time when the Federal Reserve starts to cut interest rates. So what we've seen since 1965 is that on average, the stock market has actually produced a positive return of 5% from the 12 months following the first interest rate decrease. Now, to contrast that, kind of the tale of two stories here, are that if the US economy goes into a recession, what we've seen is the stock market on average has delivered a negative 3% return in the 12 months following that first interest rate cut. But to the contrary, if the economy does not go into a recession, if we do experience that soft landing, then we've seen the market deliver on average about a 15% return in the 12 months following that first cut. So some things to be optimistic about if the economy stays resilient, and there is a stark difference in results during times where the economy avoided a recession throughout the 12 months following an interest rate cut versus those when a recession did occur. So that leads me to our third key theme on the minds of investors today, which is, of course, the presidential election. Many people have predictions on what could happen in the election and, of course, in the economy and the stock market. But the one thing to note is that there is very little correlation between what happens in the presidential election and what happens in the stock market, specifically over the long term. Now, we know the one thing that causes volatility more than anything else is uncertainty. And going into an election year, there is an incredible amount of uncertainty. What you can see in this chart that was put together by the Capital Group is that leading up to the primaries, there is typically a lot of uncertainty in the markets, which creates volatility. But what you can see on this chart is once a lot of that uncertainty starts to dissipate, we've got some more firm information after the primaries, and of course we lead into the actual election in November. That volatility starts to dissipate, and in fact, it traditionally has turned positive for overall markets. And what you can see over on the right side of this chart is that market returns aren't truly correlated to the party in office. For example, if we look at a 10-year average of stock market returns, they are about equal whether a Republican was in office or a Democrat was in office. You can see the data here. The average 10-year return of the stock market when Republicans were in office was just over 10.5%, and the average return when Democrats were in office was just over 11%. So again, no direct correlation to the party in office and the overall performance of the stock market. While there is some uncertainty leading into this election year, we believe the best course of action is to invest in being prepared, not investing in predictions. Again, what we saw was 2023 was quite a humbling year for economists, for forecasters, for people who are trying to make predictions in the market, and for those that stayed the course in their disciplined investment approach and followed their plan, they were rewarded. And we see that same theme playing out here in 2024. Now, that's not to say that there aren't events that could rattle the markets. Of course, some acute change in some of the geopolitical tensions that are out there could certainly rattle the markets. But again, we believe that with all of the data that's available today, that the best course of action is continuing to stay the course, stay disciplined, and not letting these short-term events drive uncertainty in your own financial plan. So again, we appreciate you joining us for our Q1 2024 Market Intel Report. And if there's anything we can do, please don't hesitate to reach out.
Financial planning and advisory services are offered through Prosperity Capital Advisor, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. Alison Wealth Management and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through Alison Wealth Management are not affiliated with PCA. Information received from this video should not be viewed as individual investment advice. Content may have been created by a third party and was not written or created by a PCA-affiliated advisor and does not represent the views and opinions of PCA or its subsidiaries. For information pertaining to the registration status of PCA, please contact the firm or refer to the Investment Advisor Public Disclosure website. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the disclosure statement carefully before you invest or send money.